capital structure policy, business cycles, and macroeconomic conditions.
Trade-off theory suggests that the choice of capital structure is based on achieving a balance between tax benefits and the costs of bankruptcy. The value of the tax benefit depends on the cash flows of the firm, which in turn depend on the business cycle. This suggests that there should be a relationship between capital structure and macroeconomic conditions. Trade-off theory suggests that when cash flows are high, firms should issue more debt to take advantage of the tax shield. Furthermore, when bankruptcy costs are low, firms can afford to bear more debt. Trade-off theories would thus suggest that debt should be higher during expansions because cash flows are higher and bankruptcy is less likely. An empirical relationship between business cycles and capital structure has indeed been observed. However, the relationship is not what trade-off theory would predict. Korojcik and Levy examined how firm-specific traits and macroeconomic conditions play a role in the capital structure decision. 15 Their research supports components of both the trade-off and pecking order theories. Trade-off theory states that firms balance the tax benefit of debt against bankruptcy costs. The more a firm can benefit from the tax shield, firms that are profitable and have high tax rates, and the lower the cost of bankruptcy, firms that have a high credit rating and substantial collateral, the more debt they will be able to assume. The findings were consistent with this. Firms with large tangible assets had relatively more debt. Large tangible assets serve as collateral and therefore decrease bankruptcy costs, than firms with unique or intangible assets that tended to have less debt. The authors added another dimension to the analysis by dividing firms into two categories, constrained and unconstrained. Constrained firms were those with inadequate internal funding and that faced high information costs in external markets. Unconstrained firms were those with adequate internal funds. High information costs arise from information asymmetries whereby the market may be uncertain about a firm's prospects, although management, with access to all the information, sees a promising future. Findings showed a significant difference in choices of capital structure between constrained and unconstrained firms. Target leverage is procyclical for constrained firms and countercyclical for unconstrained firms. In other words, constrained firms were more leveraged in times of expansion and less leveraged during downturns. In contrast, unconstrained firms were less leveraged during expansions and more leveraged during downturns. Whereas the findings for constrained firms are consistent with trade-off theories, the findings for unconstrained firms are not. Instead, they are consistent with pecking order theory that would suggest that during an expansion, when there is greater availability of internal funding, firms can avoid external financing. Overall, the authors found that the capital structure of unconstrained firms was closely related to the macroeconomic environment, but that of constrained firms was driven largely by deviations from target capital structure. It seems that constrained firms do not have the luxury of timing the market, and that the choice to issue more debt is not a choice at all, but firms take what they can get. Finally, it seems that the pecking order theory works well for unconstrained firms, whereas constrained firms tend to behave as though they have a target capital structure. Hackbarth, Meow, and Moralik also explored the relationship between capital structure and macroeconomic conditions and found that leverage is countercyclical, a firm's debt structure being 40% larger during booms than during periods of contraction. 16 In a related paper, Chen explained that the capital structure decision has more to do with business cycles and macroeconomic conditions than trade-off theory suggests. 17 By modeling firms' behavior under various economic conditions, he found that the capital structure of firms that are more sensitive to systematic, market, risk should be countercyclical. The explanation for this is that cash flows and required returns will be very sensitive to macroeconomic conditions. Chen also related the expected growth rate and volatility of cash flows to the likelihood of default and management's decision to issue debt. He found that low expected growth rates cause a firm to wait to issue additional debt and lead a firm to default sooner.